Imagine a company, right? Its stock is just cratered, down over 99%. It's even facing a delisting threat from NASDAQ. But could this same company still be on the verge of some multi-billion-dollar tech breakthrough that totally redefines cancer treatment? Or is it, and this is the tough part, just a classic value trap, waiting to catch hopeful investors?
Welcome to the deep dive. Today we're plunging into NuCana Plix, that's NCNA, on the NASDAQ capital market. We're going to take a really comprehensive look at this company, its tech, its rather shaky financial health, and how the market sees it right now. And this is all based on data up to August 24, 2025, with a last close of, $3.44 a share.
Yeah, and our mission today really is to take all this detailed research we've gathered on NuCana, its business, the management financials, market feeling, the frankly significant risks, and boil it all down, distill it into those key insights that you need. We're digging for those nuggets, those aha moments, to help you figure out if this is genuinely a misunderstood opportunity, maybe on the edge of something huge, or if it's more of a cautionary tale the market's already decided on.
Exactly. And look, this isn't your standard biotech story. It's not straightforward. We're dealing with these really stark contrasts. On one side, you've got this genuinely fascinating proprietary technology. But on the other hand, well, there's a financial picture that looks like a constant, desperate fight just to survive. It really is a high-stakes bet. Okay, so let's try and unpack this. We're going to break it down into clear chapters, make it easy to follow along. We'll kick things off by getting a grip on what NuCana actually does and where it hopes to fit in the massive world of cancer treatment. So let's jump right into Chapter 1.
Business analysis.
Okay, so NuCana, PillFX, it's what we call a clinical stage biopharmaceutical company. What that means, essentially, is their whole focus is research and development, R&D. They're trying to create new cancer therapies, and this is crucial. Right now, they generate absolutely zero revenue from selling any products, none. So all their costs, and they are substantial for R&D, admin, everything, it all has to be funded by issuing stock, equity and other external financing. This total dependence on the capital markets, it's not just a detail, it's the defining vulnerability of the whole operation. They constantly need more cash to keep the lights on and the science going.
And the science they're hoping pays off.
Yeah.
That's where it gets really interesting, right? This ProTide technology. Can you explain that a bit? Is it like a smarter way to deliver chemo?
That's a pretty good way to put it, yeah. Think of ProTide as a delivery system. It takes older, established chemotherapy drugs, these things called nucleoside analogs, basically chemicals that mess with cancer cell growth, and the goal is to make them much better, more effective, potentially safer.
How does it do that?
Well, the idea is to overcome the known problems with these older drugs, things like resistance, where the cancer stops responding, and toxicity, those harsh side effects. ProTide is designed to get the active part of the drug directly into the tumor cells more efficiently, sort of bypassing those resistance mechanisms and hopefully reducing the damage to healthy cells.
Okay, got it. And they have specific drugs using this ProTide tech.
They do. Two main ones in development right now. First is NUC 7738. This is a ProTide version of a compound called 3-deoxyadenosine. It's in a phase 12 study for advanced solid tumors. And interestingly, they have an expansion cohort looking at it combined with pembrolizumab. You probably know it as Keytruda.
Oh yeah, the immunotherapy drug. Big one.
Exactly. And they're testing that combo specifically in metastatic melanoma patients who've already become resistant to other similar immunotherapies, the PD-1 inhibitors. So a tough-to-treat group. Then there's NUC 3373. This one's a ProTide of a really common chemo drug, 5-fluorouracil or 5-FU. It's in a phase 1b2 study, also being tested with Keytruda for advanced solid tumors, and also with another chemo drug, docetaxel, for lung cancer. So multiple shots on goal, theoretically.
Okay, so innovative tech, drugs in trials targeting major cancers. You'd think maybe the market position would reflect that potential. But you mentioned the stock price earlier. What is their actual standing in the market right now?
Yeah, the reality is starkly different from the scientific promise. As of late August 2025, NuCana is a microcap stock, tiny. Its market capitalization is only around $6.56 million.
Wait, $6.5 million? For a company with drugs in phase 2 trial?
Precisely. It's incredibly low, and that reflects, as you said, that catastrophic drop of over 99% from its 52-week high. And maybe even more critical right now, it's currently non-compliant with NASDAQ's $1 minimum bid price rule.
Meaning they could get kicked off the exchange.
It's a very real threat, an existential one. They're literally fighting to stay listed. This isn't just a rough patch, it's survival mode.
Wow. Okay. But despite all that, the core idea, The value proposition is still there.
Yeah, the why care for you, the listener, is still that ProTide technology. The fundamental aim is still to tackle those big drawbacks of traditional chemo, make it work better, make it less toxic, delivering those active anti-cancer metabolites right into the tumor cells. That potential is still the theoretical core value.
But they're not alone in this fight, are they? The whole cancer drug space is huge.
Oh, absolutely not alone. The broader industry context is massive. Global biotech is projected to be, nearly $6 trillion by 2034. Pharma over $3 trillion. Huge growth.
And oncology is a big piece of that pie.
It's the dominant piece, really. Oncology R&D is where so much focus is. Plus, you have trends like precision medicine really taking off, which NuCana's targeted approach fits right into conceptually. And even AI is getting involved in drug discovery now. The specific markets they're aiming for are enormous, too. Metastatic melanoma, that's an $8 billion market this year, maybe $18 billion by 2032. And the wider advanced solid tumor market, well, it's hundreds of billions. $207 to $362 billion estimated for 2025. Just immense potential reward.
Okay, huge potential market. But what about the competition? Who are they actually up against?
It's fierce. You've got the giants, the big pharma companies like Bristol Myers Squibb, Merck, companies with billions in R&D, huge sales teams, established drugs already on the market.
Right, the Goliaths?
Exactly. But it's not just them. There's also a whole swarm of other small cap and micro cap biotechs, names like Virapta Therapeutics, Trevena, Cyrus Pharmaceuticals. They're all chasing the same investor dollars, the same limited spots in clinical trials, the same scientific talent. It's incredibly crowded. And unlike the big players, NuCana is basically a single platform company. Everything rides on ProTide working and working soon.
And getting it approved is another mountain to climb, I assume, the regulatory side?
Oh, it's a huge mountain. The regulatory environment is incredibly complex. You've got the FDA in the US, the EMA in Europe. The approval processes are long, expensive, and uncertain. We're talking R&D costs that can easily top $2 billion for a single successful drug. The failure rate is high. Maybe only 1 in 10 oncology drugs that even make it to phase 2 actually get approved. Plus, you need rock-solid patents, intellectual property protection, and then you need the ability to actually manufacture the drug at scale if it does get approved. The barriers to entry are just massive.
So given all that, does NuCana actually have any kind of competitive advantage, a moat around its business, as they say?
Well, let's be blunt. They have no brand recognition. They have no cost advantages from being big. They have no network effects keeping doctors locked in. Their only potential moat is that proprietary ProTide technology and the patents they have over 398 granted patents globally. That sounds impressive.
At least it's a but.
Yeah, there's a significant but. That IP portfolio, their supposed moat, has already been tested in court and found, vulnerable. They lost a UK court battle with Gilead Sciences over 2 of their European patents related to ProTides. The court found them invalid.
Ouch. That's not good.
It's really not. It sets a worrying precedent. If those patents weren't strong enough, what about the others? It potentially weakens their negotiating position for partnerships. It invites future challenges. It casts a shadow over the whole platform's defensibility.
Okay, let's shift gears slightly. Chapter 2. Management evaluation. This is another area that seems contradictory. You mentioned the leadership team. The CEO, Dr. Hugh Griffith, had a successful exit with BioEnvision. The chairman, Professor Chris Wood, led Algeta to that huge $2.9 billion Bayer acquisition. These are impressive resumes, seriously successful track records in this exact field. Yet, this same team has overseen this near total wipeout of shareholder value, that 99.8% stock decline we keep coming back to. How do you square that circle? What stands out to you about this disconnect between past success and current reality?
It's a really tough question. And honestly, it's central to the NuCana story. You have proven experience, yes. But the market for microcap biotech, especially pre-revenue ones, has been absolutely brutal. Now, looking at what management did do recently in 2025, their actions were very clearly focused on one thing: corporate survival, tactical moves. They did that 1-for-200 reverse stock split. That wasn't about creating value. It was just a maneuver to get the share price back over the $1 NASDAQ minimum. Purely compliance-driven.
Kicking the can down the road, maybe?
Arguably, yes. They also managed to raise $38.4 million through capital raises. That was crucial, extending their cash runway, they say, into 2029. Buys them time. And they used about $3.6 million of that cash to cancel outstanding warrants. That helps remove some potential future selling pressure when those warrants could have been converted to stock. So actions were taken, but they were reactive, defensive moves to stay in the game, not necessarily moves that addressed the underlying reasons for that massive value destruction.
And in terms of just basic Corporate governance, communication, ethics,
Yeah.
anything unusual there?
Not really. They seem to follow standard public company practices, regular press releases, SEC filings. They have a formal corporate code of conduct on their website. It looks like standard procedure from that perspective.
Okay, but let's talk about how they use money they do raise, capital allocation.
Right. And if you connect their survival tactics to the bigger picture of capital management, it confirms this laser focus on just keeping the science funded. 100% of the capital they raise goes into R&D and running the company. That's it. There's no M&A strategy here. They're not buying other companies. There are no dividends for shareholders, obviously. And definitely no share buybacks to support the stock price or return cash.
Instead, they've been issuing shares. Lots of shares.
Massive amounts. That's the flip side of raising capital when your stock price is so low. It leads to extreme shareholder dilution. That share count increase you mentioned earlier, 16,887.9% in the past year. It's almost hard to comprehend.
16,000%.
Yeah. It means for every share someone held a year ago, there are now nearly 170 shares outstanding. Your slice of the potential future success has been diluted down to almost nothing, and this is reflected in a key metric, return on invested capital. ROIC. It's currently sitting at a deeply negative 235.5%.
Minus 235%. What does that even mean?
It means that for every dollar invested in the business over that period, the company has effectively lost about $2.35. It's a stark mathematical confirmation of the value destruction that's happened during this development phase. It underscores that even with brilliant science, how you manage capital is absolutely critical.
Okay, that leads us naturally into the numbers themselves. Chapter 3, financial analysis.
Right, let's look at the key metrics. And as we've hinted, the financial profile is, well, it's challenging. First, market cap, as we said, tiny, $6.56 million. Puts it in the nano-cap space, which inherently means high volatility, high risk. Revenue growth trends, not applicable. They have zero product revenue. Profit margins, also not really applicable, or you'd say deeply negative. It's all driven by costs, R&D, general, and administrative. Their EBITDA loss for the trailing 12 months was $26.8 million. The net loss in Q2 2025 alone was $24.1 million.
So burning through cash quickly.
Very quickly. Which leads to free cash flow. Consistently, significantly negative. That's the cash burn. For the trailing 12 months ending Q2 2025, it was negative $16.35 million. They're spending much more than they take in because they take in nothing from operations.
That paints a pretty grim picture for anyone looking for traditional financial strength. Does the balance sheet offer any kind of safety net?
Not really, no. The balance sheet confirms the high-risk situation. Earnings consistency, consistently negative, always has been. Debt-to-equity ratio, this is a big one. It's exceptionally high at 2.09x, or 209%.
Meaning they owe more than twice what the company's theoretically worth from an equity perspective.
Essentially, yes. It reflects how much the equity base has been eroded by losses and debt relative to assets. It's a sign of significant financial leverage and risk. Now, the current ratio is 1.58x. That suggests they can cover their immediate short-term bills of their current assets. So short-term solvency isn't the immediate crisis.
But it doesn't mean they're stable long-term.
Not at all. And obviously, dividend stability and growth, none, doesn't exist. Overall, the financial state is one of existential risk. Their survival depends entirely on those scientific breakthroughs happening before the cash runs out, even with that runway extended to 2029, thanks to the recent raise.
Okay, so with financials like that, how on earth do you value this company? Can you even use traditional valuation metrics?
It's extremely difficult, and mostly those standard metrics are useless or actively misleading here. PE ratio, it's NANX 0.01x. Mathematically meaningless because there are no earnings. Price to book, PB ratio, it looks low, maybe 0.01x, or sometimes reported around 1.1x, depending on how you calculate tangible book. But it's kind of a mirage.
Why mirage?
Because a lot of the book value isn't tangible assets like cash or equipment. It includes intangible assets, maybe deferred tax assets, things that have little or no real liquidation value, especially if the company fails. And the actual cash they do have is being burned through rapidly.
So book value isn't a reliable floor here. What about trying to figure out an intrinsic value, like with a discounted cash flow DCF model?
Theoretically, a DCF is the right approach for valuing future potential, but practically, for NuCana right now, it's highly speculative. Pure guesswork, almost. You'd have to make huge assumptions about the entire life cycle of their drugs if they get approved. You need to estimate the probability of success, POS. For oncology drugs going from phase 2 to approval, that POS might only be, say, 15% to 25%, maybe lower.
So a high chance of failure baked in.
Exactly. And then you need to choose a discount rate to reflect the enormous risk. For a company like this, you'd use a very high rate, maybe 25%, maybe even higher. The slightest change in these highly uncertain assumptions, POS, discount rate, future revenues, completely swings the calculated value. It's just not feasible to produce a reliable, useful intrinsic value range. You're basically modeling a hope, not a predictable business.
Okay, moving into the second part of our deep dive now, looking at the broader picture. Chapter 4, Market Sentiment. All right, this is where my head starts to spin a bit. Analyst price targets. You look them up, and it's just wild. Some analysts have targets like $5,000 a share. That implies, what, 145,000% upside from where it is now?
It's an astronomical number, yeah.
Then others are maybe $104. Still a huge upside, but vastly different. And then, confusingly, one major data provider shows a consensus target of literally $0. What is going on here? How can the experts be so completely all over the place?
It really highlights the extreme binary nature of this, doesn't it? Those super high targets, the $5,000 ones. You have to assume they're modeling a scenario where everything goes perfectly right, 100% success, massive market penetration, and probably aren't properly risk adjusting for the high chance of failure. The market itself, the actual trading price, clearly shows that investors have dismissed these blue sky scenarios. They're just not seen as realistic right now. You absolutely have to view those high targets with extreme skepticism.
So treat those mega targets as like lottery win scenarios.
Pretty much. And the recent news flow hasn't helped build confidence either. You get these potentially encouraging snippets of early clinical data, which is good, but they're consistently drowned out by the drumbeat of financial struggle announcements about raising more money through dilutive offerings, that warrant cancellation, the reverse split just to stay listed. The financial narrative tends to overshadow the scientific one in the market's eyes right now.
Okay, so analysts are divided. News is mixed to negative. What about the market's own actions? The technical indicators, what are they telling us?
Well, if you look at the technicals, the message is pretty clear, and it's overwhelmingly bearish. Negative. First, short interest. It's substantial. Over 12.2 million shares were reported short as of the data. That's a significant number of investors actively betting against the stock, suggesting a strong, conviction-based bearish sentiment.
People are putting serious money on it going down further.
Exactly. Then look at the moving averages. The stock price, $3.44, is trading significantly below its 50-day simple moving average, which was around $5.21. That's a classic short-term bearish signal. And even more tellingly, it's drastically below its 200-day simple moving average, which was way up at $8.576. Trading so far below the long-term average indicates a deeply entrenched long-term downtrend.
So no signs of a technical turnaround yet?
None whatsoever based on these indicators. The market's actions are screaming caution, or worse.
Okay, let's look at who actually owns the stock. Chapter 5, ownership structure.
This is another area that, frankly, raises a major red flag for me and likely for many experienced investors. Institutional ownership, that's ownership by mutual funds, pension funds, hedge funds, so-called smart money, it's incredibly low, just 0.218% of the company. Almost nothing.
0.2%.
Yeah.
That's basically negligible.
It really is. And insider holding shares owned by the company's own directors and executives are similarly tiny at 0.0174%. The CEO himself owns only about 0.013%. It forces you to ask that critical question. If the people who supposedly know the company best, the insiders and the sophisticated professional investors the institutions aren't buying, why should anyone else? Their near total absence is a powerful negative signal.
Yeah, that lack of skin in the game from insiders and institutions is telling. What's fascinating, or perhaps worrying, is that despite the stock price collapsing over 99%, we've seen zero open market purchases or sales by insiders in the last 12 months. They're not buying the dip even at these levels, but they're also not selling what little they have. What do you make of that standstill?
It's silence that speaks volumes, isn't it? You might expect buying if they truly believed a turnaround was imminent at these low prices. You might expect selling if they'd completely lost hope. The fact that there's nothing, it could suggest uncertainty, maybe restrictions, or perhaps just that their current holdings are already so small relative to their wealth that it's not worth transacting. Regardless, it doesn't inspire confidence.
So if institutions and insiders own virtually nothing, who does own the stock?
The consequence of all this is that ownership is overwhelmingly concentrated with the general public, 99.8% according to the data.
So almost entirely retail investors.
Yes. typically individual retail investors. And while retail investors are crucial to markets, they may often be less equipped to analyze and bear the very complex, very high risks associated with the speculative microcap biotech like NuCana. This situation is a direct outcome of that massive shareholder dilution we discussed. That 16,887.9% increase in shares outstanding effectively transferred ownership away from earlier investors, including institutions that might have been involved previously, and into the hands of whoever bought the newly issued shares, predominantly the public.
Okay, let's try to bring all these pieces together now. Chapter 6, Risk Assessment. Let's use a classic framework, the SWOT analysis. Strengths, weaknesses, opportunities, and threats. How does NuCana stack up when you lay it all out?
Okay, let's walk through it. Strength. The main one is still that proprietary ProTide technology and the science behind it. They also have that extensive IP portfolio, although we have to add the caveat that it's proven fragile. They do have experience management despite the stock performance, and crucially, they secured that extended cash runway into 2029, which buys them time.
Okay, some definite positives, mainly around the science and time. What about the weaknesses?
The weaknesses are severe, and importantly, they amplify the threats. No revenue, extremely high cash burn, the history of catastrophic shareholder dilution, the striking lack of smart money ownership, institutional and insider, and that ongoing NASDAQ non-compliance risk. These are deep internal problems.
Right, and the opportunities.
Opportunities are mostly external. The huge addressable oncology markets we talked about, the real unmet medical need for better cancer treatments, the potential, however distant, for a lucrative partnership or acquisition if the clinical data turns out spectacular, and the broader tailwind from advancements in precision medicine.
And finally, the threats.
The threats are numerous and existential. The absolute biggest one is clinical trial failure. If NUC 7938 or NUC 3373 fail in their key trials, that's likely game over. There's ongoing financing risk. Will they be able to raise more cash after 2029 or even before if needed, and on what terms? There's the intense competition we discussed, and there's always the risk of regulatory rejection by the FDA or EMA, even with positive data. The key takeaway from the SWOT, I think, is that NuCana has almost no financial cushion. Its weaknesses make it incredibly vulnerable. A single major negative event, a bad trial result, a financing failure could be fatal for the company.
Beyond those company-specific things, what about broader economic or political factors? Do they play a big role here?
They absolutely do, especially for a cash-burning company like this. Persistently high inflation and interest rates are a major threat. They make it more expensive for NuCana to potentially borrow money, but more importantly, higher rates make investors less willing to gamble on high-risk, long-shot stocks. Money flows to safer assets. Also, things like the U.S. Inflation Reduction Act, IRA, could impact future drug pricing and profitability for all pharma companies, potentially reducing the size of the prize, even if NuCana does succeed someday.
And being a UK company adds another layer, right? Geopolitics. Tariffs.
That's definitely a factor to consider. Post-Brexit, trade dynamics are still evolving. There's the potential for future U.S.-imposed tariffs. While pharmaceuticals haven't been the main target historically, the political landscape is unpredictable. President Trump has mentioned the possibility.
So tariffs could hit their costs if they need to run trials in the U.S. or eventually sell there.
Potentially, yes. It adds another layer of uncertainty and potential cost increases for a UK-headquartered company operating globally, especially in the critical U.S. market. It's another headwind they don't need.
Okay, we've covered a lot of ground. Let's bring it all together. Chapter 7, Conclusion. So let's try to synthesize this. First, the bull case for NuCana. What else is the optimistic view, the reason someone might still take a speculative bet here?
Right. The bull case hinges entirely on the science and the potential payoff. You're betting on a few key things. 1, a genuinely differentiated scientific platform with ProTide. 2, the encouraging early clinical data they've shown, particularly some signals with NUC 7738 and resistant melanoma. 3, the absolutely massive market opportunity if they succeed in these large oncology areas. And 4, that extended operational runway, the cash they have until 2029, gives them a fighting chance to generate more compelling data.
It's a bet on a scientific breakthrough against the odds, essentially.
Precisely, a venture capital style bet placed in the public markets.
Now, contrast that with the bear case. What are the overwhelming arguments against investing?
The bear case is built on the harsh realities we've discussed, and they're deeply interconnected. You have the extreme financial distress, no revenue, high cash burn, significant debt relative to equity, and the devastating impact of past dilution. You have a clear loss of market confidence, evident in the 99% plus stock price collapse, the NASDAQ compliance struggle, and that high short interest. You have that resounding vote of no confidence from smart money, with virtually no institutional or insider ownership. A huge red flag. Their competitive moat, based on IP, has been proven fragile in court. And fundamentally, their path to market looks almost insurmountable on their own. It depends entirely on hitting a home run with clinical data, spectacular results convincing enough to attract a partner or buyer before the cash runs out and before the market completely writes them off.
And valuation doesn't offer much help either way.
No. As we said, traditional metrics are useless or misleading. A DCF is purely theoretical, highly sensitive to assumptions you just can't make with any confidence. That current $6.56 million market capitalization, it's not an oversight. It reflects the market assigning a very, very low probability to NuCana successfully navigating all these risks and bringing a drug to market. The market is pricing it for a high likelihood of failure.
So wrapping this all up, what does this mean for you, our listener, thinking about NCNA?
The bottom line is that NuCana Price represents a binary, extremely high-risk venture capital-style speculation. It's a bet on a scientific hypothesis, not anything resembling a traditional value investment based on fundamentals or current operations.
Yeah, you're not buying earnings or assets here. You're buying a chance, a lottery ticket on the science working out against formidable odds.
That's exactly it. The probability of success appears low based on the multitude of severe, immediate, and interconnected risks: clinical, financial, market, competitive, regulatory. Consequently, the probability of a partial or even a total loss of invested capital is exceptionally high. That's the stark reality the current market valuation is reflecting.
You know, considering everything we've unpacked today, this really tantalizing scientific promise, set against such brutal financial realities and market skepticism, it leaves me with a final thought. In this world where a single scientific breakthrough can be worth billions, how long can that pure scientific promise actually survive when it's starved of financial stability, and especially when the market itself seems to have already lost faith? It's a tough question for companies like NuCana. Well, that concludes our deep dive today. If you found this analysis valuable and want more like it, here's an opportunity for you. Please like this video and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority access to deep dives on tickers you request. Plus, over the next few months, we're actually planning to cover all of the S&P 500 stocks, and members will get exclusive priority access to those in-depth analyses as they come out. But if you just want a one-off deep dive into a specific stock that's on your mind, drop us a super thanks with your request, and we'll prioritize it for you.
And just a reminder for everyone, this analysis was generated by an AI system. It's intended for educational and informational purposes only and should absolutely not be taken as financial advice. Always, always conduct your own thorough due diligence, do your own research, or consult with a qualified financial advisor before making any investment decisions.